I'm David Pastana, broker and owner of Rise Utah Realty, active realtor in the Utah area, Utah County specifically. And I just wanted to address some questions that I think people are having concerning the housing market. We know that the coronavirus is slowing the market down. So the question is, do you think a housing crisis is coming? And I say, think again. So during this webinar, if you like what you're seeing and you want to see the slides, again, you can text to 801-899-0438. Text the word webinar and it will auto reply to you with a link to this presentation so you can get a copy, okay? So if you like any of the graphs, just do that. It's at the bottom here of this slide. All right, so going forward here, I just want to show you here the most up-to-date stats. Literally, I got this email for March, and it really shocked me. I knew that the market was going good, but right now, right here, it shows 20 days on market. That's the median days on the market. That is really strong. A normal market would have 6 months. So 20 days on the market is incredible. The median price here at $340,000, I put in yellow, that's up 10.3% from a year ago. So what all these stats are showing is we haven't slowed down, at least through the month of March. Now, granted, COVID, this whole coronavirus started in March. Really, it was when our first case was. So maybe our April stats will be lower, but man, January, February, and closings for March, it went down. Now, typically what you see is days on market. If that's low in March, that means that we're going to have some pretty good number of closings in April. Boots on the ground, what I'm seeing is that's going to hold true. So here, let me adjust that a little bit. All right, so what we're seeing here, let's just give a case update so you know where I am talking. This is April 17th, 2020, and as of today, we have 632,548 cases of coronavirus or not worldwide, but nationwide here. Excuse me, I get people texting me as I'm doing this presentation here. Right here, what I wanted to show you is the Utah. It's not coming up for some reason. Well, Utah has like 2,500 cases is what it was going to show us, which we're up. Over a week ago, it was about 1,800. So we're moving upward. You know, so many of us get the news from like New York and we get panicked from that. But as far as Utah is concerned, you know, our cases have been pretty mild and our death rates have been actually less than 1%. So that's all good news. But nonetheless, because we're all shut down, the coronavirus is affecting the markets. And I think we really first saw it as it came out. And as they initiated closures, you saw it in the stock market. And this is the stock's percent drops, which this is from Bloomberg. Of course, as travel bans hit, these are showing the travel bans that you see in place right now, or that are affecting flights. So far fewer flights than before. The red line here is 2020, and you can see that it's going down. And of course, because of all the shutdowns, we're seeing high unemployment start to hit the markets. You know what? It really hit once the market said that you get more benefits. And then, so when they passed that stimulus bill and they increased the benefits, and that made everybody really file for unemployment. So you can see for April, like look at the previous months, it's like nothing. And all of a sudden, man, April, you know, in Utah, I heard that last week we filed more unemployment for unemployment benefits in 1 week than they did in the entire 2019 year. So that really tells you how things have changed. Although those unemployments could be temporary, they are high right now. So not everyone's suffering though. I have neighbors and other people who are doing really well. I thought it was funny because here, Clorox, I mean, we're all using Clorox wipes all the time. Their stock is up quite a bit. It's like up 50% since the beginning of the year. Good for them. And another interesting thing that's up is orange concentrate. We're all drinking orange juice apparently at home, and the supply of it's up. So it's selling very good. Well, where we are right now just is we're really, a lot of people are waiting for those stimulus checks and trying to track when they'll get out. So the IRS is working on that, and hopefully yours is in the mail. But I think what's going to help the economy is knowing when we're going to reopen, because up until this point, there's been no sure date. And although we don't have a date, Trump here states that basically he gave guidelines here for the states to open. So you can go to the site and you can read through those. And although you may not be happy about them, at least it gives some form of structure to how we're going to reopen the market. And, for Utah, I think that'll probably start in May. Although they did close the schools through the end of the year, but that initial phase 1 will start probably then. Although I'm not in charge of that, I'm hoping, how about that it starts in May. So here's the bottom line, as far as, where we are economically, because this is going to lead into housing, if you're still with me. Hopefully you're still with me. Give me a thumbs up if you are. But there is pressure to reopen the economy, and that pressure is growing fast. Not everyone is affected like New York, although most of what we see is coming from New York. I think it's important to hear right here that people want to work and they have to work. It's important to know that, we're talking about real family, real lives, and they need to pay for things. And we're feeling the crunch. It's basically been 2 solid months. And really, as far as mortgage payments, we're going to look at 3 solid months of loss of income. And another important thing is there's an opportunity to work. It's not like it's not there. They can go back and continue work if they're just allowed to open up. So these Trump guidelines, the president guidelines, the federal government guidelines really are going to help give clear rules for us to open up. And, we pray to hit those criteria as quick as possible. So that's kind of where we're at and in the market. It's good that it seems like a lot of the death rates, or at least the infection rates, are starting to plateau. That's what they're calling for. All right, now with that said, let's focus on the housing market. Everybody is wondering about that, and so let's talk about how all these things are affecting the housing market. There's five reasons I think we're in a good position. I'm going to hit on all these 5 topics. One is home appreciation, the mortgage and credit, number of homes sold, the use of home equity, and general home equity today. So let's go through these. All right, I got all these slides from Keep Your Current Matters, and they analyze all these stats. And in the red here, so this is 2000 through 2005, and in the green, we have 2014 through 2019. So this is 6 years on each side leading up to a slowdown. You can see that through 2000 to 2005, we had much higher appreciations. Now, let me say that these numbers are national numbers, where currently in the last 5 years, we've had a good appreciation, but it's been much more mild compared to before. So it's not as crazy, and that's a good thing. More mild appreciation helps to keep us in line with wages and affordability of homes. So this is historic data for mortgage credit availability index. So everybody needs to buy, most people I should say, need a mortgage in order to buy a home. And the higher this mortgage credit availability index is, that means it's easier to get a loan. And that's not always a good thing. At some point, banks give loans to people who don't really deserve them. And in the early 2000s, we called that subprime mortgages and stated income loans, where they were giving loans to people who really didn't or couldn't afford them. So although at the time everyone thought, hey, this is great, home ownership is up, this is all great. In the end, there's a certain amount of people that really don't deserve to buy a home and can't afford one either. So that's what caused the precipitous drop in the market. So today we've seen that this affordability, mortgage credit availability index, excuse me, is remained fairly stable here, and just somewhere between 1 and 200. We're about 150 right now, and so that's not crazy out of line. That's a good thing. Next, months of inventory. You can see that in the previous market over here, this is the market, and this is leading into the crash. When things crashed, the days on market and inventory went up. So, whoops, inventory here. So normally they had somewhere between 4 and 5 months of inventory. The market crashed, they had a ton of inventory, and when you have this between 6 and 7 months is what's called a neutral market. That's typically when prices stay flat. If you're above that, it's called a buyer's market, and home prices are going to drop. And the higher they are, they're going to drop even bigger. When you're below that line, you tend to have what's called a seller's market, and that's when prices will go up. So right now, not only we're in a seller's market, we have very low inventory. Utah's inventory is below 2 months. So that's on this scale, it's about as tight as you can get for a seller's market, and it pushes the price up. So until we see that number change, you're not going to see prices drop in housing. It's just too much pressure because of the seller's market. There's too many buyers wanting the same home, and they bid on it, and the prices go up. All right. The other thing that we talked about, or that I said I would mention, is this: how this is total home equity cashed out. Man, I was in mortgage back in the day, and everybody was refinancing and just pulling tons of money out. These dollars they pulled out, like their houses, rates were dropping, and every time they would drop a 0.25%, they would refinance. They pull another $20,000 to $50,000 out of their home. They go buy a car. You know, they weren't reinvesting it into the market. They were just buying things, and that helped and increase the market. But right here, what this is billions of dollars that each year that people would pull out and cash out refinances. These are huge numbers. I mean, 321 billion in 2006. That was probably the pinnacle. And then the year before the crash, they still pulled out $240 billion, even though they knew a slowdown was coming. Insane. So in that time, they pulled out $824 billion. Now, compared to right now, the last 3 years, you know, we're 1/3, 1/4 the numbers as what they were doing before. That means we're not cash out. We're not taking cash out of our home. We're not taking that equity out. So we have equity in our homes, and that's a good thing. So let me get to that. So because we have equity now, like we've learned from those mistakes, and so as people's homes gain value, they have equity. And what does that mean? Well, if you have equity in your home and you lose your job, you can sell your home, and you have, you know, maybe $100,000, $200,000 that you can live on. If you're just low on cash and you can still qualify, you can get an home equity line of credit, and that will allow you to pull cash out of your house on a monthly basis as you need it to take care of bills. So the number here is interesting. I mean, look at this. Of all the homes in America, 53.8% of all homes in America have at least 50% equity. Do you hear that? At least. So that means that half of the homes have, like, if your home's worth $100,000, you have $53,000 in equity, so that you can take out, and that's half of America. I was impressed by this stat here. Americans are sitting on a tremendous amount of equity. Look at this bottom one. 37% of homeowners are free and clear. That means they don't even have a mortgage on their house. That's insane. And so they're never going to be in financial trouble. And 26.7% of the mortgaged homes have at least that 50% equity. So the 26.7 is like all mortgages. That's how much they have. But when you look at it as a whole, it averages out to 53%. These are impressive numbers. And so when everyone's worried about the market crash, we have a big equity difference. I think that's one of the biggest things. And we're on stable mortgages, so people really would afford that. So what it comes down to is that what will our job loss be in the future? If the job losses go up, the equity could save a lot of people, really could. I mean, if you have equity in your home, again, you can take some cash out, or it gives you the ability to sell. And if you can sell, we're not going to have a high foreclosure market. See, it leads, can you see the steps? When people got in trouble, they had no equity. They were up, what we call upside down on their home, where the value dropped. So they had more mortgage than house. We're not seeing that. And so they couldn't do anything. Therefore, they foreclosed. Right now, there's no way you're going to foreclose. You won't do it. Not if you have 100,000 in equity. You're going to take that out. So you may not want to sell, but if circumstances hit you hard, you can sell. And that's what I'm trying to get at, is you can sell. And here's remember, the other side is that inventory is low. So there are people out there who are willing to pay full price for your house right now. And so the circle's completed. So if you're in financial trouble, you can sell. You're going to get $100,000 in equity out, and you're going to be able to live and move on and provide for yourself or your family or whoever you support. So these are some of the main things why we won't technically have a housing crisis, because there's too much equity, and people can sell, and there are buyers for it, and you can pull that equity out. All right, so here's the bottom line. COVID-19 crisis is causing challenges across the country that don't compare to 2008. There's just not that comparison. This is a health crisis, not a financial crisis. We know that housing is in a much stronger position today than it was in 2008. It is no longer the center of the economic slowdown. Housing is most likely then to help pull us out of this downturn. And housing does represent 17% of the economy. So if that's doing well, builders are building, and all the supply companies, it's a huge market out there. All right, so that summarizes this presentation. Do any of you have questions out there that I can answer as we're on? Again, you can get a copy of all these stats that I shared by texting webinar to 801-899-0438. Again, these topics aren't widely understood by people, and there's so many people out there that I talk to. Not so many, really. Honestly, it's probably a fewer percent. But they really think that, okay, now I'm going to wait. This is it. This is the time where I'm going to get that super deal. And so they backed out from buying. What I've seen is that the pressure to buy has slowed the market down into April. I've definitely seen that. But we were so fast on the market before, that what do I want to say? We were so fast on the market before that you couldn't, you could hardly get an offer in because of the multiple offers. Right now, because a certain percent have stepped away, maybe that percent could be from the temporary unemployed, you can put in an offer. An example is there was a new construction where we were not getting many. Well, at the end of last year, we had kind of had a pick. There was like, five homes available, and you could pick which one you want. Then into the new year, you couldn't do that anymore because they were selling with multiple offers. And in a 3-month or in a 4-month period, it raised the prices on those units 10%. And because of multiple offers. And now you can get those again. They have a few days on the market before they sell out. But the key is they're still selling out. But because they're not selling out with multiple offers, they're not raising the prices fast, but they're not dropping it either. So we can get deals out because we're not having as many multiple offers. We can still get things like paid closing costs or maybe a discount. But the houses in the lower price ranges is what's really pushing it, and you're still lucky just to get the house and get it at the price they were asking for. So, hey, just reach out to me direct. You can also text that number, and I would love to answer any questions you have. I have listings that I can send you, and whether you're an investor, a first-time buyer, or a seller, we can get you what you need. We're here for you. We want to help you succeed. And I hope these stats today have helped you and you'll benefit from those. Please share this with your friends, and thanks. And I'm going to close the webinar. I appreciate you all watching today.